In this presentation, we will discuss personal financial statements, the statement of net worth, and the statement of cash flows, and ratio and trend analysis. By the end of this lesson, you should be able to describe the difference between corporate and personal financial statements, explain how to construct a client's statement of net worth and statement of cash flows, and discuss ratio and trend analysis. Financial statements are scorecards that provide a wealth of financial information about a person or a company. As you can see on this slide, there is a basic set of financial statements for individuals and a basic set for businesses. The personal financial statements include the statement of net worth and the statement of cash flows. Corporate financial statements include the income statement, balance sheet, and statement of cash flows. Footnotes often accompany both personal and corporate statements. The footnotes contain additional details about statement line items. While the two sets of statements aren't identical in name or number, they essentially offer the same information. We'll explore the information contained in the personal financial statements as we proceed through this lesson. Financial statements need to be constructed on sound financial principles. Important principles are objectivity. Information in the statements needs to be verifiable and measurable. Materiality. All relevant and significant items need to be included in order to present an accurate picture of the individual's or the corporation's condition. Consistency in creating the statements. Consistency will enable useful comparison of data over time and between persons and entities. Conservatism. Conservative methodology ensures that the true condition of the person or entity is not overstated. And full disclosure of all material information. It's important to include information that would improve the reader's understanding of the statement. There are several distinct differences between corporate and personal financial statements. Corporate statements need to comply with generally accepted accounting standards. That's GAAP. Personal financial statements do not. For example, accrual accounting, which is the matching of assets and liabilities, is generally the accounting standard for corporate statements. Cash accounting is used in creating the person's statement of cash flows. Corporate assets are booked on the balance sheet based on historical cost basis. Assets appear on the statement of net worth at fair market value. The statement of net worth may also be referred to as the statement of financial position or the balance sheet. This document provides a snapshot of the client's financial net worth at a point in time. It lists the value of assets and the value of debts or liabilities. You may recall hearing the statement, assets equals liabilities. Well, we hope that personal assets don't equal personal liabilities. If they do, your net worth at that point in time is zero. Take a look at the diagram on the slide. The assets are depicted in yellow and appear on the left side of the statement. The liabilities or debts are shown in green on the right-hand side of the statement. When you subtract your financial assets from your liabilities, you discover your net worth. The net worth is depicted in blue on the right-hand side. Do you see now why the sides of the balance sheet balance? It's because net worth is added to liabilities. That sum equals the value of assets. Let's go back again to that statement, assets equal liabilities. In a business, the net worth is not owned by the legal entity, for example, the corporation. The net worth is owned by the shareholders. That is why you don't see the wording net worth, but rather shareholder equity. So if shareholder equity is considered a liability, then assets do equal liabilities. Does that make sense? Note that personal and business financial statements are accompanied with footnotes. These footnotes are extremely important, especially when analyzing business statements, because they contain a lot of information that will help you interpret and go behind the numbers. For example, a long-term lease doesn't appear on the balance sheet. However, the contract has long-term cash flow implications. Here is a typical statement of net worth. The assets appear on the left and the liabilities and net worth on the right. Typically, assets are listed in three categories: cash and cash equivalents, investments, and real and personal assets. Within those categories, assets are listed in terms of short-term versus long-term liquidity. Liabilities appear in two categories: current liabilities and long-term liabilities. A current liability is usually due in 1 year and shorter. As previously mentioned, the assets on a statement of net worth reflect fair market value. So, if your client purchased their home for $150,000 and appreciated at $500,000, then the asset would appear on the statement as $500,000. That is a number that you need to know in creating the financial plan. Similarly, if a client purchased a car for $60,000 and the blue book value on it is now $15,000, then $15,000 should appear on this statement. The client may have a life insurance policy for $1 million. That amount would go to the beneficiary. The only amount that would appear on the statement of net worth is the cash surrender value. Similarly, the client might participate in an employer's qualified retirement plan. The appropriate value to show on the statement is the vested benefit. You'll learn more about retirement assets investing in your retirement course. Debts show the current principal balance. For example, a mortgage with an original loan value of $400,000 and a current remaining balance of $320,000 would be shown on the statement as $320,000. The statement of cash flow may also be referred to as the statement of income and expenses, or perhaps just the income statement. This document provides a movie of the client's cash inflows and outflows over a period of time, typically 1 year. It shows the sources and values of income and expenses. As depicted on this slide, the difference between net inflows and net outflows is the savings or the deficit. There are several different categories of expenses shown: non-discretionary fixed expenses, non-discretionary variable expenses, taxes, and discretionary expenses. We'll examine each of these in the following slides because they have important implications when it comes to budget analysis and cash flow management. Non-discretionary expenses are cash outflows that must be paid if you're going to meet your debt obligations and maintain your same standard of living. Example of fixed non-discretionary expenses include rent, insurance premiums, home mortgage payment, educational loan payments, property taxes, and car loan payments. Not all non-discretionary expenses are fixed. Examples of variable non-discretionary expenses are food, utility bills, medical and dental bills, clothing, personal care, and transportation. The reasons these are categorized as variable is because the client does have the ability to manage the expense to a limited degree. For example, exercise and prudent diet may reduce one's medical or dental costs. There is certainly some discretion concerning food purchases. Taxes include FICA payroll taxes, which go towards Social Security benefits and Medicare benefits, federal income taxes, and state income taxes. The client has considerable control over discretionary spending. Notice some of the high-ticket discretionary expenses listed on this slide: a vacation, the trip to Hawaii, entertainment, a new car, a home remodel, purchasing a vacation home, going out to eat at restaurants, jewelry, gifts, and donations. Financial statements offer a visual planning tool for the client and the planner. Purposes include to provide a better understanding of the client's financial position. For example, assets available today, where the cash is coming from, how it's being used. It identifies opportunities and challenges related to cash flow and potential risk exposures, for example, the need for insurance. It highlights progress towards client goals, including the building of net worth. And it can be used in measuring financial plans' performance. Up to this point in the lesson, we focused on historical statements, those statements providing information about current financial net worth or cash flows over the last year. Another important use of financial statements is in forward projections or pro forma statements. The pro forma analysis includes gathering client information, estimating future inflows and outflows, projecting those forward-looking statements. In creating pro forma statements, you might consider using different scenarios. For example, a worst-case scenario, the expected scenario, and the best case scenario might be useful in communicating budgeting with your client. Two useful tools for analyzing financial statements are ratio analysis and trend analysis. Ratio analysis puts comparisons on an apples for apples basis. For example, let's say client A has annual debt payments of $10,000 and client B has payments of $20,000. At first glance, it appears that the second client is carrying a larger debt burden. But that's an incomplete picture. What if that first client had annual gross income of $50,000 and the second $200,000? The corresponding debt ratios are 20% and 10% respectively. That completely changes the picture. Trend analysis looks at the numbers or ratios over time, and this analysis is quite important. For example, consider the same client, client A. What is your assessment if the person's debt ratio moved from 28% 3 years ago to 20% total today? That's a positive trend. This slide shows several categories and ratios that are of interest to the financial planner. Liquidity focuses on the ability of the client to keep the lights on in the house, food on the table, and a roof over one's head. The emergency fund ratio compares cash and cash equivalent assets to monthly living expenses. The ratio effectively describes how many months of required living expenses would be covered by these liquid reserves. Three important categories of debt are the consumer debt, housing debt, and total debt. The consumer debt ratio compares yearly consumer debt payments, including auto loans, school loans, credit card debt, to yearly take-home pay. The housing ratio compares the sum of yearly mortgage principal and interest payments, property tax, and home insurance to the yearly gross income. The total debt ratio is the sum of the consumer and housing debt payments to gross income. It's important to remember that debt analysis needs to consider, to some extent, where the client is in his or her life cycle. In evaluating the client's savings progress, the planner generally focuses on the amount of money dedicated to retirement savings. For example, deferrals into an employer's qualified plan, contributions to IRAs compared to gross income. Another ratio that you might find useful is the capital accumulation ratio, which compares total retirement assets to net worth. When assessing investment portfolio performance, the planner will generally focus on total annual return, which includes dividends, interest, and capital gains divided by that beginning of period investment dollars. Ratio benchmarks serve a variety of purposes. They help us evaluate the client's financial status by providing a baseline comparison. They help us start a conversation with the client about use of cash, particularly with cash flow behavior that's well outside of the norm. They may offer useful context in establishing budgeting expectations. Moreover, they're useful for measuring performance or improvement in obtaining loans. The CFP CFP curriculum benchmarks are depicted on this slide. The liquidity benchmark is 3 to 6 months of living expenses. Where a client should be within that range depends on the family circumstance, such as the number of adults working, the projected amount of time to get another job, lifestyle needs, number of dependents, etc. The consumer debt ratio benchmark is less than or equal to 10 to 15% of take-home pay. A consumer debt ratio of 20% is considered a red flag. The housing ratio benchmark is less than or equal to 28% of gross income. The total debt payment ratio benchmark is less than or equal to 36 to 38% of gross income. The savings ratio benchmark is often shown as 5 to 10% of gross income. However, it's really more dependent on the situation. A 5% savings rate might be appropriate for a 28-year-old professional. The same amount would be insufficient for a 50-year-old executive who has not saved up to this point in his life. Perhaps even more important than the specific ratio is the trend in the ratios. That's because the trend reveals improvement or decline. For example, a 42% total debt ratio raises a red flag compared to the CFP benchmark. However, there's a totally different picture created when you see that the 3-year trend improved substantially as the ratio dropped from 42% to 40.8% to 39.9%. In combination, ratio and trend analysis provide you with valuable analytical tools to help you plan for your client. In this lesson, you learned about the difference between corporate and personal financial statements, the statement of net worth, the statement of cash flows, and ratio and trend analysis.